Yes, people, a very, very happy morning to all of you. So, guys, here we begin with the very first class of the CA Foundation Accountancy. And today we are going to look at the introduction of the accountancy chapter. So, accounts, in my opinion, I feel it is a very conceptual subject which requires no need to by heart any format or formula as such. Of course, formula you have to quote it wherever required, but there is no need as such to by heart. Format, of course, we have to remember it because we have to present in the requested format. But that apart, there are a lot of things in account which is conceptually understandable. I don't know why people have a lot of fear associated with this particular subject. But however, let me give you a complete assurance with the amount of time that we are going to spend on the basics and with the amount of time that we are going to spend on the explanation aspect of each and every chapter, it's my assurance and promise to all of you that I'll make your life, as long as the accountancy subject is concerned, very, very smooth and very, very easy. Right? So let's commence the accountancy subject. So before we technically understand what is accounting, I want to understand from all of you in a layman language, that is in simple language, as to what does accounting mean? Accounting means what in a layman language, if I have to ask you?
Count.
Accounting means? In simple layman language.
To count.
Wonderful. Accounting means to count. Very simple. In the word accounting itself, there is a word called as count. So we need to understand this. What are you talking about? What are we going to count here? Everything and anything we're going to count here. For example, in business does purchase. Purchase happens on day-to-day basis. Every day you purchase. Some business do weekly purchases. As and when you purchase, you have to record in accounts. So you keep on purchasing. The purchase value needs to be accounted in the accumulated manner. Purchase value, I want to know at the end of the year, what is the total count? So today I buy the goods, I record it. Tomorrow I buy the goods, I record it. So we keep on accumulating the purchase, and the process of accumulating the purchase value in a particular place is called as accounting. Because what do you do? Once you accumulate the values one after the other, you do totaling. At the end of the year, you get to know this is the total purchase that has happened throughout the year. Same thing for sales. People do sales every day. So as and when the sales is taking place, you record it in the books of accounts. So that at the end of the year, you total it and get to know what is your total sales. Then cash coming in. The more and more money coming in, every transaction you keep on adding. So adding is nothing but accounting. And from that, if you're spending any money, you subtract it and get the balance value. Again, accounting. Simple layman language. What is accounting? Sir, to count. Okay, sir. Technical meaning of accounting we'll understand in next few minutes. These are the three basic questions which I want to understand, or which I want you to understand from a layman point of view. Second thing that we have to understand is why do we need to learn accounting, or why do we need to do accounting? Accounting is a term that is broadly associated with the business. Accounting we do for business transactions. So the primary purpose of doing accounting is to find the end result of any business. We want to evaluate the performance of the business. So how do you evaluate the performance of the business? By identifying the profit and loss of the business. As a businessman, I want to know how is my business performing? Am I in profit or am I at loss? Only by doing accounting, you'll get to know the performance of your business, whether you are at profit or you are at loss. A business in the initial stages may not be 100% profitable. There are certain businesses which will be straight in loss for back-to-back 3, 4, 5 years. So accounting will make you understand, okay, in year 1, so much was the loss. In year 2, so much is the loss. And this over a period of time should gradually fall. But on the other hand, the loss is constant in all 4-5 years with no significant improvement, then that should give you a thought process about whether should you continue the business or close it down. As a businessman, I want to know, how is my business performing? Am I doing better than previous year? So I have to have a comparative analysis, comparative data. So where does the data come from? Accounting. So why accounting? To evaluate the performance of the business, and the performance of the business is evaluated through profit and loss. This is primary requirement. Otherwise, if you go into the subject, what is the purpose of accounting? What is the objective of accounting? What is the advantage of accounting? It runs for several pages. Here I'm talking from the layman point of view. Simple, a person who does not understand accounting. If you tell him, or if you ask him, why do we need to do accounting? He will say, to find profit and loss of my business. Prima facie requirement. So are you clear? Why are we studying accounting? Primary reason. Sir, third. Sir, accounting I understood. Why accounting also understood. But why do we have so much of accounting rules and regulations? Why do we have the concept of debit credit? Why do we have to follow double entry system of accounting? Why do we have to follow cash based accounting or accrual based of accounting? What is golden rule? What is modern rule? Why do you have to follow that? There's so many accounting principles: matching principle, historical cost concept, prudence principle, prudence concept. Why? If I ask you, what will you say? To maintain the uniformity. Uniformity in the sense? Same means what?
Format, presentation.
Only format presentation you want to make it same?
The recording.
End result also needs to be same. Very good point. But if you do not have accounting policies, principles, and rules in place, if you give a free hand to people to do accounting the way they feel like it, for a given question, each one will have different way of presenting the answer. And at the end, you'll be in confusion and chaos. Who's right, who's wrong? So always there'll be a bias argument that I'm right, I'm wrong, or you're right, or you're wrong. So to avoid that bias, it is very important to have the accounting rules and regulations in place. So can you give us an example? Like, can you justify this through an example? Yes, of course. Let me give you a small example. That we are into business of buying and selling laptop. So we purchased 10 laptops at the rate of 40,000 each. Purchased 10 laptops at the rate of 40,000 each. Sold 8 laptops at the rate of 80,000 each. I'll make the question first very simple. If I ask you to calculate the profit or loss of the business, how will you do it? I'll give you 1 minute of time to calculate. Tell me what is the profit and loss of the business. 1 minute of time, guys. All of you, quickly read this question and tell me what is the profit and loss of the business. 3,20,000. Okay. Any different answer? Online, please try it and tell me. 2,40,000. So 2,40,000 is one answer. 3,20,000 another answer. So I gave you classic example, and I told you for a given set of problem, if you do not have accounting policies, principles, rules in place for given one set of problem, you have a multiple answer. Imagine the plight of a business owner. One accountant is saying this is my profit, another accountant is saying that is my profit. Look at the plight of government. Government is interested in your business because taxes are collected on your profits. If you give 2 profits to government, no, government will wonder which profit is correct. Obviously, government will take the higher profits because higher profit, higher tax for the government. Banker who is giving loan to you, on what basis is giving loan to you? He's looking at your profit. He's getting attracted by your profit. Because of that, he's giving loan to you. Now, if you give him 2 different answers, 2 different profit, will he not get confused? So those who gave me 2 answers, I want you to tell me how do you calculate it. Please tell me option 1. This is option 1. Those who said 320. No, 240 first, right? Yeah. 240? Okay. Please tell me how did you get the answer, Kana? You took sales 80,000 to 8? Okay. So sales 80,000 is the selling price. I sold 8 laptops. So how much is my total sales? 6 lakh 40,000 rupees. Wonderful. Sir, how do I get my profit and loss? Sir, from my income, I minus expense, I get profit and loss. So sale is my income. From that, I'm minusing purchase. Purchase is my expenditure. So minus purchase. What value is it? 40,000, sir. 40,000, sir. How many laptops?
8, sir.
No. You took 10 laptops. Yes. 10 laptops. How much? Sir, 4 lakh. $640 minus 4 lakh is 2 lakh 40,000 is my profit. Correct? 2 lakh 40,000 is cash in hand. I asked profit. He said profit 240. Now, option 1 is this. Option 2. Option 2. How did you calculate? So we took sale 80,000 into 8. How much? 6 lakh 40,000. Wonderful. Minus purchase 40,000 into 8. Because 8 laptops sold, for it proportionate cost has been derived. How much is it? 3 lakh 20,000. What is the profit? 3 lakh 20,000 profit. Wonderful. 2 options. Please tell me which among these 2 are correct. Option 1 or option 2?
Option 2, sir.
Option 2 is correct.
Option 2.
Okay. Option 2 is correct is what you're saying. What is wrong in option 1? Which principle is violated? Which principle is violated? Loudly. Wonderful. What does matching principle says? Expenses, that is never said. Expenses, if it is equal to income, then you never get profit and loss. No. The quantum of expenditure should be equal to the revenue that is being earned. So in option 1, you violated the matching principle. Please don't think that, sir is not explaining matching principle, sir is not explaining anything. Directly is asking so many questions. I'm just trying to set an atmosphere. Small basic test. Everything will be doing like deep diving. Everything will be discussed. Don't worry. Even if you give the answers wrong, don't take it to heart, because all of you here invariably will make mistakes at some point or some stage or the other. Nobody is expert as of now until I make you expert. Nobody is expert in this room except like that. You will think. You should never have that much pride that I am the best. No, just be grounded. Matching principle says that the quantum of expenditure, here you have recorded income for 8 laptops and you recorded expenditure for 10 laptops. Matching principle says this is wrong. You should record that much quantum of expenditure only, which is contributed to the revenue of that year. So if 8 quantities of laptops is sold, and for that what sale value is recorded, proportionate expenditure only is supposed to be recorded. Am I clear to this point? So option 1 is wrong. Option 2 is right. Option 1, what went wrong? You violated the matching principle. Don't worry, I'll be discussing what is matching principle, everything in depth. This 240 technically is cash in hand, rightly said by Piyush. You said that, sir, this 240 is cash in hand. 640 money came in. 4 lakh you spent out money. So 6 lakh 40,000 is cash in hand. So this calculation is not totally wrong. Had they asked you in this question, what is the cash in hand? Then 240 only is correct. Because 6 lakh 40,000 is cash inflow and 4 lakh is cash outflow. If I minus it, my net flow is 240. That is cash in hand is 240. This aspect in depth we'll be discussing where, in the final accounts. In the final accounts, when you prepare the trading and P&L account, that time I'll explain you in depth why only purchases net 8 unit is being taken. My motive of touching base this concept is to make you understand that for a given set of problem, if you do not have the rules, regulations, principles, and policies in place, each one will do accounting the way they feel like. Thereby, the end result will be like this. Each one will come out with a different result, which will create a chaos and confusion in the hearts and the minds of the stakeholders. Stakeholders means who? The business owner himself first. He will not have any clarity whether my profit is 240 or 320. So he is at confusion. Second problem is with the government. Government says on which should I collect tax? On which profit should I collect tax? If given option, government will always want to go with higher profits. Higher profits, higher taxes. Banker is not able to understand which profit should I look and give him the loan or not. Banker feels that if this is the profit, I'll not give him further loan. But if this is the profit, I might give him a loan. So like that, there's so many stakeholders, internal as well as external, are dependent on your performance of the business, who are dependent on the result of your business. So it is very important to have accounting policies, principles in place. So that for a given set of answer, you can have for a given set of question, for a given set of problem, you can have a uniform result. Uniform result. So now a person who learns accounting with proper policies and principles, the same question you give even to 1,000 people, everybody will give the same answer. That is the power of having the accounting rules and regulations in place. Guys, are we clear with the first three important things? What is accounting? Why accounting we have to learn? And second is why accounting rules. Are we clear with this point? Now, technically, let's try to understand what is accounting. Technically, let's understand what is accounting. So, accounting is a systematic process. Systematic process. What does systematic here means? The first thing here means double entry system of accounting. System in accounting means double entry system of accounting. Second, what is the meaning of systematic? Wherever you go, whichever place you go, there is a rule that you have to follow. There's a system you have to follow. There's a process that you have to follow. System means what? It makes the things more organized. So here, accounting is an organized process or a systematic process of what? Identifying a business financial transaction and event. Until 11th standard, what did I tell you? Identifying a business financial transaction. I never mentioned anything about event. Now we are upgraded. Now we are upgraded to foundation level. So you have to learn something new. Sir, identifying a business financial transaction and event. Meaning of it, I'll explain. Please wait. Measuring in terms of money. Recording through journal. Classifying through ledger. Summarizing in form of trial balance, P&L balance sheet. Interpreting, analyzing. And finally, communicating the financial information to the various users of the financial statement. Who are the users of the financial statement? Two types, category. Internal users, external users. That's all. I'm not going too much into. So we didn't understand anything, sir. And I didn't even explain. I just read it. Have you seen this movie in Hindi called as Three Idiots? Amir Khan movie. In Tamil, we have Nanban, Vijay. So in that particular movie, there's a scene where Amir Khan or Vijay is sitting in the classroom and he's enjoying that lecture. He's having a smile. He's laughing. And suddenly the professor says, "Hey, why are you laughing?" He says that, "Sir, it was my dream to study in the engineering college. And today when I'm sitting in this college and listening to all of you, I'm feeling very happy." Then the lecturer says that, "Stop being happy about it. Tell me the definition of machine." So he tries to put it in simple language. But the professor does not accept it. So in Hindi movie, we have somebody called as Chatur. And in Nanban, I think Srivatsan, if I'm not wrong. Yeah. So when that guy is being questioned upon, he gives a very technical definition of machine, which we cannot remember. So like that, accounting also has got a technical definition. What is accounting? Accounting is a systematic process of identifying a business financial transaction, measuring in terms of money, recording through journal, classifying through ledger, summarizing through trial balance, P&L, balance sheet, interpreting, analyzing, and finally communicating the results to the users of financial statement. A performance match. 10 times if I repeat this dialogue, I'll become a pro. No, Charan? Like that, if I explain, will anybody understand? Each and every part we have to break down. So one by one, let's do the postmortem. Sir, identifying, sir, what are you trying to identify? A business financial transaction. So basically, we are going to understand the accounting cycle or accounting step-by-step procedure. This process is exactly the same way how you learned the English language. You remember? Once upon a time, all of you were kid, 2 years old, 3 years old. The moment you were born, did they put you into school and say, write paragraph, write essay, précis writing, essay writing? How did you start? Sir, we started with alphabets. A, B, C, D, E, F, G. I'm training my son. No, that flow is there for me. 3 years old. You learned alphabets first. Then what did you do? Once you become a pro in alphabet, then your teachers taught you how to put alphabets together to make a word, to make words, to make the constructive words. And once you became pro in words, then they taught you how to construct sentences. Once you became a pro in sentence, they taught you how to construct the paragraphs. Once you become a pro in writing the paragraphs, then they kicked you out of school. Because chapters you never wrote, no? In your lifetime, did you ever write any book or chapter? No. If you become an author, then you will have a privilege to continue from here. Otherwise, school said, get out from here. This is more than enough for you to survive the remaining life. Those who continued their journey to become author, then those people use this paragraph to make chapters and chapters into wonderful books. So this is the process of learning the English language. Similarly, there's a process of learning accounts, which begins with identification of a business financial transaction and event. So first we have to understand what is the meaning of transaction. What is the meaning of transaction? Transaction means, trans means through, action means to do, which means we are trying to do something through somebody. We're trying to get something through somebody. I want to buy laptop. Will I say Om Bhur Bhusva laptop Prastutam Swaha, laptop will come automatically? There will be some person manufacturing. I don't know the manufacturer. He would have given it to wholesaler. That person also I don't know. Then that person will give to retailer. So I'll go to retailer and buy it. So I'm buying laptop through a retailer. You want to learn accounts? Can I say, hey God, give me one single this thing, one shot full accounts, lifetime accounts I should learn in one shot? No. He's like, I'm sending Pratik sir, you wait. Through him, you learn. So transaction means what? Obtaining something through somebody. That through is me here. So transaction means an activity that happens between two or more people, which involves exchange of goods, services, or funds. Exchange of goods. I buy goods, I give cash. Transaction. I buy goods, in return I give goods. Transaction. But that is called as barter system. When you exchange goods for money, then you're buying goods for cash. But if you're buying goods for goods, that is called as barter system. Correct? Services. You guys are receiving service. You guys are receiving service, and for that I'm receiving money. So service is exchange for money. Then funds. Money deposited in bank, money withdrawn from bank, exchange of funds. Also transaction. Correct? No? A senior accountant giving the petty cash to the petty cash accountant. Transaction. What are they exchanging? Money. Correct? No? exchange of money, exchange of goods, exchange of services called as transaction in accounts. So every transaction will involve two or more person or two or more accounts. So are you clear with the transaction part? Ram purchases chair from Raja on cash. So here exchange of goods or services? So exchange of goods. Purchases, sorry, chair is goods here. So Ram is buying goods from Raja. So exchange of goods, transaction. Ram pays salary to Sita. Why is Ram paying salary to Sita? Because Sita gave service to Ram. So again, exchange of transaction. So exchange of service is one transaction. Exchange of money is another transaction. So are you able to understand what is the meaning of transaction in first place? Okay. Second is event. Sir, what is event? It is the consequence of the transaction. It is a consequence of the transaction. Transactions, I would say. Sir, meaning it is the end result of the transaction. Example, profit and loss. So you do a transaction of buying goods. You do a transaction of selling goods. If I net this off, what do I get? Profit and loss. And that profit and loss is termed as event. So what is transaction? Transaction means what? An exchange of goods and services happening between two people. Event is what? Whatever transaction happens. Transaction with multiple transactions put together, it will create an end result or a new result, and that result is called as event. So profit and loss is one end result. Second event example is closing inventory. Can you go in the stock market or can you go in the market and buy closing entry? Hey, please give me 2 closing inventory today. Can you tell? Closing inventory is not a transaction. You cannot go buy transaction. Sorry, you cannot go buy closing inventory anywhere in the market. You buy laptop. How much? In our example, 10 laptop you purchased. How much did you sell? 8 laptops. So 2 were remaining in hand. So it's the result of the transaction. How did 2 laptops come into your hand? Closing inventory. So it is the result of buying 10 laptops, selling 8 laptops. So your closing inventory is a end result, which is event. So do we need to remember all this from examination point of view? 100% yes. This is very well there within your syllabus. You might get the true and false question. In the very first introduction session of the CA Foundation, I gave you the examination pattern. So question number 1 is compulsory question. In that first A question, how many true and false do you have? 6 true and false, each carrying 2 marks. So they'll give you a question. Closing stock is a transaction, true and false? False. Closing stock is not a transaction, it is a event, because closing stock is a result of the difference between purchase and sales. So you might get a question. So each and every point that I'm saying, guys, is very important from not only true and false point of view. This again will be applying in the various practical questions. So please pay full attention. 1 minute of loss of your concentration can create a huge loss for all of you. So every single minute is very, very important. Please do not deviate. So are we clear with the event and transaction? So what are we trying to do first? Sir, we have to identify a business financial transaction, because for me to account something in the books of accounts, I need to know what am I accounting. In India's in world, so many transactions take place. Of all the transactions which is relevant for accounts, I should be able to identify. So we are learning the process of how to identify the transaction. So first you have to identify business financial transaction and events. So in that I've taught you how to identify a transaction and event. Closing stock is an event. Should I not record it? Yes. At the end of the year, closing stock, what do you do? As an adjustment, you record it. So event has to be recorded. Some event like profit and loss, you don't record it. It is automatic end result. Value automatically it comes. No need to record. But there are certain events like closing stock, which has to be identified for recording purpose. So transaction event, we are clear. So second point is finance. In accounts, anything and everything that I record has to be in the number value system. It should be measured in terms of money. we cannot record anything which cannot be measured in terms of money. For example, let's say I have interviewed one candidate and I've confirmed and I've given a offer letter that from coming Monday, please join. Does it qualify for a transaction? Yes, because here there is an exchange of contract. There's an exchange of contract. So I've given an offer letter. The staff has signed and given the acceptance back. So that calls for a transaction. This transaction, can I record in accounts? If yes, at what value and what will be a journal entry? There's no answer. Correct? So like that, in business, there's so many transactions which cannot be measured in terms of money, and therefore you cannot record that in the books of accounts. So first and the foremost important point is any transaction that you identify, you should be able to measure in terms of money, which means it has to have a value assigned to it. Clear this point? Sir, third point is business. Every financial transaction event will you record in the books of accounts? The answer is no. Only a business identified financial transaction needs to be recorded. Let's say I go to the theater today, buy ticket. I buy ticket, I buy popcorns. Is it a transaction? Yes, sir. Because it is an exchange of goods between me and the theater. Is it involving money? Yes. It is involving money? Yes. Can I record this in books of accounts? No, because it's a personal transaction. Can we record personal transaction in accounts books? No. So it is very important that the financial transaction that you've identified should be happening in the course of business. So a business financial transaction needs to be identified among the thousands of transactions that you do on day-to-day basis. Am I clear with this point? So many transactions lying in front of you. So you have to pick and choose the transaction. So on what basis will you choose? On the basis of business financial transaction and events. And the justification I gave all of you. Clear? Second, once you identify a business financial transaction, you should measure in terms of money. So finance is that point, measuring in terms of money. But measuring in terms of money means one more extra point. What that could be, please tell me. When I say business, financial transaction and events. So finance, I said it should have a monetary value attached. There should be a monetary value attached. There should be a number system. This is called as money measurement concept. This is called as money measurement concept. Why this has to be in finance or in numbers? There's one more reason to it. Tell me why. Tell me what. Common denomination. Wonderful. In India, when you do business, is it any compulsion that you have to deal with transaction only in India? No. You are allowed to do cross-border transaction, which means what? You can buy and sell goods across multiple countries. So I bought, let's say, some goods from India for rupees 10,000. Then I purchased some goods from Australia. So there we pay Australian dollars 1,000. Then I purchased something from USA. So there I had to pay US dollars 500. Can I say my total purchases 11,500? Can I say my total purchase is 11,500? Because mathematics says what? When you want to add 2 or 3 variables, it should be of same denomination, same units of measurement. I can never add liters with kg. I can never add kg with pounds. So whenever you add 2 variables, it should be of same common unit. Same way, in India, the common unit of measurement is INR, Indian rupees. So what have you done here? 10,000, the first transaction is recorded in INR, no problem. But the next 2 is not in the Indian denomination. It is in the foreign denomination. So you have to convert into INR. So let's say if I multiply this by 60 and this by 70. Tell me now, guys. This is same 10,000. How much is my Australian dollars purchase value? 60,000. And US dollars? 35,000. Now all the 3 are in common denomination. Now if I add, how much does it turn out to be? Sorry? 1,05,000. Now, if I say this is my total purchase, is it okay? So the process of converting the various units or denomination to common denomination is called as money measurement concept. Or through money measurement concept and principle, you convert the values of different units and denomination to one common units of denomination. So are you able to understand why do we need to identify a business, financial transactions and events? Business means what? The transaction has to happen in the course of business. Second, it should have a monetary value attached, and that should be in common denomination of INR. Third, there should be a transaction taking place or an event taking place. If all of this is identified, then you head forward to the next step of accounting, which is called as the process of recording. The process of recording. So in accounts, the recording takes place through two ways. One happens through journal. Second happens through subsidiary books. I will not talk about the subsidiary book as of now. So when we do the subsidiary book chapter, that time I'll discuss in depth. My focus is only on the recording aspect and more importantly only on the journal aspect as of now. So identifying a business financial transaction event is a theoretical work. So when I did this process, nowhere the accounting has commenced, nowhere the accounting started. The accounting will start now with recording. So accounting is a systematic process of identifying a business financial transaction, measuring in terms of money, and recording through journal. And journal is called as book of original entry. Book of original entry. We have studied 11th standard. Journal is called as book of original entry. Why did we say book of original entry? Because that is a book where the transaction is originally recorded for the very first time. It's an origin where the accounting begins. So that is why it is called as book of original entry. Whereas subsidiary book is called as books of original entry. Because subsidiary book is series of multiple books. Whereas journal is one single book. So journal is called as book of original entry where the recording happens. In accounts, anything and everything that you record, change will happen only through journal. Let's suppose you did journal. From the ledger, trial balance, you prepared trading P&L, balance sheet, everything done. While preparing the balance sheet and trading P&L, you identified there's a mistake. Are you allowed to do the correction on the face of balance sheet and P&L? That yes, this is wrong, so I'll minus it. Profit value, sale value is wrong, so I'll minus it there. Purchase value is wrong, so I'll add it there. Are you authorized to do any changes directly in the financial statement? The answer is no. Anything and everything that you do, it has to begin from journal. So if anything goes wrong, you have to again come back to journal, ledger, trial balance, financial statement. If anything is done wrong, again, come back to again journal, ledger, trial balance, financial statement. So this is the entry point. This is the entry point. We have the data entry point, no? Computer, we have, you give input. The system will process it and give the output. So journal is basically your input stage. Anything and everything that we have to alter in accounts. What is the feeder stage? The feeder. You understand what is a feeder? Have you seen this sugarcane big machine? I'm not talking about the olden day machine. Now there is a latest machine where inside that box there will be a sugarcane crusher, and to make it beautiful, they have given an outer line box to it. So in that outer box, there's a small feeder hole where they'll put the sugarcane inside. So that hole is called as feeder, where the sugarcane is input. So this journal is like that feeder. This is the outer box of the sugarcane machine where you have to feed the data. You feed the data. If something goes wrong, if you want to alter it, rectification entry, what do we do? Come back to journal. Remember rectification entry? Rectification of errors. Any mistake you did, you never went and touched the financial statement directly. You came back, passed the journal entry, re-prepared the ledger, re-prepared the trial balance, re-prepared the financial statement. So that important this journal is. So journal is a stage where you have to do the recording. Sir, what are we supposed to do here? For us to do recording, what are we supposed to do here? First step of journalizing is identify the accounts involved. So my question goes to all of you. What does accounts mean? What does accounts mean? What is meaning of accounts? Systematic records of transaction. Okay. Others. What is accounts? Name under which we categorize the things. Point taken. How many of you feel like telling sir accounts is a ledger? How many feel like telling it? One. Accounts means ledger. How many of you want to, or how many of you getting the feeling of saying that as an answer? Raise your hands properly. Accounts is a ledger. Two answers. Accounts is not ledger. Accounts comes under ledger. Ledger is a book. Ledger is book name. In ledger, we have multiple accounts. Accounts is one common place where you record a particular type or nature of transaction. So for example, we have something called as purchase account. So purchase account is a place where all the transaction related to purchase is recorded in one common single place. That is called as accounts. Able to follow. Then we have something called a sale account. What does sale account mean? So in business, whatever happens in relation to sales, everything will get accumulated to one common place called as sales account. So once you identify a business financial transaction, an event, out of that you have to identify how many accounts are going to get affected. How many accounts are going to get affected? So first step is identify the accounts involved. Second thing that you're supposed to do is identify the nature of accounts. Whether if you're following golden rule, then the accounts what you've identified. For example, to come back to this transaction, Ram purchased chair from Raja on cash. So this is a transaction. First of all, transaction or event? Transaction. Okay. Second, does this involve money? Yes. Here the value is not given, but money is there. Without payment, nobody will give you the chair. So finance also is there. Second, is it happening in the course of business? Obviously, because Ram is into business of buying and selling chair. Let's assume that. So it's a business financial transaction. First step, success. Second step, what? Recording. For me to record, what am I supposed to do? Sir, pass a journal entry. For me to pass journal entry, what is the first step? Identify the accounts involved. So what are the accounts affected here? Ram account? Sir, no, because we are recording in the books of Ram. So Ram will never account himself. Correct. Sir, purchase account can be record? Yes. What is the meaning of purchase? Sir, anything that I buy with the intention to resell, it is purchase. So chair, I'm buying with the intention to resell. So purchase, yes. Do we open chair account? Sir, no. We never open the account in the name of the goods. We never open the account in the name of goods. So chair account will not come. Raja, should I open? Sir, not required. We have paid money to Raja. So I don't need to remember his name. No. So I will not open Raja's account. Cash? Yes. Because money is going out. So money coming in and going out needs to be captured in the business. So the two accounts that you identified is cash account and purchase account. So what is the first step of recording? Identify the accounts involved. Second step, what are you supposed to do? Identify the nature of accounts. If you're following golden rule, then this accounts you can classify either as personal account, real account, or nominal account. If you're following modern rule, then you have to classify these accounts either as asset, liability or capital, income or expenses. So second job is to identify the nature involved, because based on the nature only, you will be next able to apply the rule of accounting. That is either golden rule or modern rule. So without first two steps, you will not be in position to apply the golden rule or the modern rule. So what is golden rule? What is modern rule? Everything we're going to see today. I'm only trying to give an outer line idea how this process works. That's all. Each and every point will go into deep dive. So accounts has to be identified first. The nature of accounts needs to be identified. Then on that, you'll either apply the golden rule or modern rule. Once the recording takes place in the journal, all the transactions will be posted to another place called as ledger. From journal, it is posted. The technical word is posted to ledger. Guys, journal, one more point. Journal you record in the chronological order. What is the meaning of chronological order? Sir, as and when the transaction is taking place, in the same order as it is taking place, you're supposed to record it. If 10 o'clock this happens, that will be recorded first. If 12 o'clock something else happens, that will be recorded second. It goes in the chronological order. Today's transaction, tomorrow you cannot record. Today's transaction, today only. So in the same order, it has to come. Sir, in the same day, can I change the order? No problem. Within that day, if you change the order, it's fine. But today's transaction, I cannot record tomorrow. That is the key thing that you have to remember. So now the problem with the journal, guys, all of you are familiar with the journal format. Anywhere in the journal, does it help me in totaling my accounts? Let's suppose you do only journal, don't do ledger at all. At the end of the year, if I ask you, what is my total purchase? Are you in position to tell me what is my total purchase? Only by preparing journal. So the format in which you're preparing journal, it does not facilitate the totaling. So therefore, for totaling purpose, there is no other option. The experts had to create the concept of ledger. So what happens from journal? Let's say this is journal. And this is the journal book where you have purchase transaction, sale transaction, cash transaction, credit transaction. That is purchase credit transaction. It's like multiple balls in one common bucket. If I tell you from this bucket, tell me what is the total count of red ball, blue ball. Are you in position to do it? Here it is still countable. So you can easily say in business there are lakhs and lakhs of transactions. Is it possible to do the totaling? Not possible. So what do? From journal, we post it to ledger for the purpose of totaling. So what happens? The red balls will go to the red bucket. The blue balls will go to the blue bucket. The black balls will go to the black bucket. So this is the process of classification. We are classifying all the transaction into each and every account. This is called as classification. You understand what is the meaning of classification? Segregating and putting it under one common head. So here in accounts, we don't open boxes. We open a T-shaped ledger. So this pink color, what you're seeing is a ledger. Let's call it as a purchase ledger, purchase account. And this blue one is a sale account. And this black one is your cash account. So what do we do here? All the purchase transactions are recorded in one place. All the sale transaction recorded in the sale account in one place. So this will help me in totaling. Once you record everything in sale account on the credit side, you will total it. And you get the balance carry down. Correct, no? So cash, debit what comes in. So all the money that is coming in, you're recording on debit side by applying the rule. Whatever money goes out, record on the credit side. Credit what goes out. Then what do? Inflow minus outflow is the balance. So ledger is helping me into classify the accounts and enables totaling of each and every account. When I prepared the journal format, it did not facilitate the totaling. So for the totaling purposes, I am forced to post all the transactions to ledger. With ledger, I have a problem. Ledger, how many books? One book for cash, one book for sales, one book for purchase. Guys, in the olden days, no system was not there. So they had manual accounts books. I'm talking about 20, 30 years ago when the computers were not there. How did they keep accounting? Like how you have accounts notebook? No, they also had accounts books. So it is all manual. So like that, they had so many books. So problem with the ledger is if the owner is asking me, Pratik, tell me, I want a complete summary. I want a complete values of each and every account. Tell me what is my total purchase. Tell me total sales. Tell me total cash in hand. Tell me total bank balance. Tell me total of plant and machinery. Like that, if they ask me total, again, I have to take one book. I have to keep searching. Where is this book? Where is that book? So this ledger is not giving a summary. Then expert said that if you want to have a summary of all your ledger balances, if you want to have summary of your ledger balances, then for that purpose, you have to prepare something called as trial balance. So trial balance gives you a bird's eye picture of the balances of all the accounts. And that is how the trial balance has been prepared. So the next step is from ledger, all the transactions, from the ledger, each ledger just got balance that will travel to the trial balance. Ledger, whichever ledger has balance, the balance will travel to the trial balance. All of you know the format of trial balance? Sir, particulars, debit column, credit column. So if a ledger has got a debit balance, it will go to the debit column. If a ledger has got credit balance, it will go to the credit column. Even at the foundation level, even at the intermediate level, some people find difficulty in understanding that what does debit balance or credit balance means. So when I come to the respective topic, I'll tell you how to identify which account has got debit balance and which account has got credit balance looking at the balances. So accounting is a systematic process of identifying business financial transaction, measuring in terms of money, recording through journal, classifying through ledger, summarizing through trial balance, trading P&L and balance sheet. So trial balance is a summarized picture, but that is not the end result. Trial balance is prepared only to check the arithmetical accuracy of the accounts. So what does that mean? All of you know that the thumb rule of the trial balance is that the total of the debit and the total of credit should be equal. If it is not equal, then somewhere you've made one-sided mistake. If only one-sided mistake is committed, then the trial balance will not tally. So whenever you go for auditing in future after articleship, and when you are actually preparing or doing audit for any company, the first thing that you will do is you will take the trial balance of that particular company and check whether the trial balance is tallying or not tallying. I'll be able to follow. So trial balance will help me to know the arithmetical accuracy of the accounts that has been done. Have we committed any one-sided mistake or not? If double-sided mistake is committed, trial balance will not be able to highlight it. Trial balance can help us highlight only the one-sided mistake. I'll be discussing about this in detail when I do the rectification of error topic. So trial balance purpose is what? Is to give the summary of the various ledger balances, account balances. And let me tell you one thing. People think that like journal and ledger are compulsory to prepare. Trial balance is compulsory. The answer is no. It is not compulsory. Without journal, accounts never begin. Without ledger, you cannot proceed forward. But without trial balance, you can still prepare the trading P&L and balance sheet. Correct, no? Again, my question goes to all of you. Without journal, can you do accounts? So journal is the entry stage, first step. If I don't do it, entry recording will never happen. So journal is mandatory. Ledger, without ledger, can you prepare the trading P&L balance sheet? No. So I need ledger to prepare that. Do I compulsory need trial balance to prepare the financial statement? Not required. From ledger, you take all the balances directly to trading P&L balance sheet. You know, the sale account balance will go to the trading account as buy sales. You know, purchases ka total will go to trading account debit side 2 purchases. Correct, no? So is there any compulsion or necessity that only if you have trial balance, you'll be able to prepare the financial statement? The answer is no. Why are we preparing trial balance? For our comfortability to check if there is any one-sided error or not. We're preparing trial balance to check if there is any one-sided mistake or not. If no one-sided mistake is there, then it is giving a satisfaction that I can go ahead and prepare the financial statement. Second, trial balance is helping me to prepare the financial statement a little bit in easy manner. Because from ledger, if I have to prepare the financial statement, how many ledgers I have to go and refer? And by chance, if I miss any ledger to be incorporated in the financial statement, it will be a problem. So when you put in trial balance, you have the complete control of all the accounts. Immediately you can post it to the financial statements. You'll have a control. So trial balance is not a compulsory norm of the accounting process, but it is done to facilitate the ease of preparing the financial statement. Am I clear on this point? Second, this trial balance is giving you the summarized information, but the summarized information does not give me the result of my business. If I want to know result of my business from trial balance, I'll identify all the accounts which has got the flavor of income, gain, or expense and losses, and that I will post it in the trading and P&L account by passing a closing entry. Correct? Sir, in the trial balance, there are multiple accounts. From that, I'm going to identify all the accounts which has got the flavor of income, gain, expense and losses. In other words, nominal accounts. And I record them in the trading and P&L account by passing an entry called as closing entry. Closing entry, you studied what is there in 11th and 12th standard. Again, I'll be repeating when I do the journey. What am I doing now? I'm just trying to give an outer line picture. I think except one or two people, all of you are commerce background. So you understand what I'm trying to tell. Correct? Okay. So, sir, from the trial balance, we identify all the accounts which has got the flavor of income, gain, expense, and losses, and we record them in trading and P&L accounts so that we can assess the financial performance of the business. Financial performance means what? So, the profit and loss of the business. So, profit and loss of the business technically called as financial performance. And then in trial balance, we have remaining accounts. After you segregate this, we have the remaining accounts which has got the flavor of asset, liability, capital. Guys, whenever I ask you something, if you keep on repeating, what will happen? One, you'll not go into sleep mode. Even if you've gone to sleep mode, you'll be able to come back again. So whenever I ask you a question, please, what will you do? Respond. So the remaining accounts left in the trial balance is got the flavor of assets, liability, and capital. And those will be put in the balance sheet to ascertain the financial position. What is the meaning of position? I want to know each and every asset. What is its balance and how much of it I own it. I want to know what is the position of my cash in hand, which means how much money is there as cash in hand. I want to know on a particular date what is my bank balance. I want to know on a particular date what is the position of my properties, how much worth of properties I hold. I want to know on a particular date how much money am I yet to collect from my debtor. On a particular date, I want to know how much money I'm yet to pay to my creditor. On a particular date, I want to know how much money I'm yet to repay to my banker as a loan. So it gives me the position of each and every account, which has got the flavor of asset, liability, and capital. This is called as knowing the position of your accounts. These two documents put together, that is trading P&L balance sheet put together, is called as financial statement. It is called as financial statement. And financial statement is basically your report card of the business. Like how you have a report card for your schools, you had 11th, 12th, where you got 20 out of 100, 40 out of 100, 50, that's all, no, final exam will get more marks after the initial stages. This is more common with the CBSE people. Correct? No? Test they will never get out of 80 mark. They'll have proper 80 mark test, 25 mark, 40 mark. And if they touch 50, we'll be celebrating. 50, we got 55, 60. But finally, board they'll get 95, 96 out of 100. They'll get the CBSE people 92. Come. When is result expected? May 12th. See? CBSE 6th is for state board people. Anyways, so like how you had report card for your schools for each and every standard, like that, this is the report card of the business. So what is accounting? So accounting is a systematic process of identifying a business financial transaction, measuring in terms of money, recording through journal, classifying through Ledger, summarizing in trial balance, P&L, balance sheet. And then what do you do? Once you prepare the financial statement, what do? You cannot sit with that. You have to go ahead and do the analysis. You have to do the interpretation. Because as an owner, I need to know whatever I targeted for the year beginning, did I achieve that or not? Every business, guys, in the beginning, when they start the year, no? Today is what, 20 April. So it's a fresh financial year. This is by Jan Feb, the finance department, along with the other department, they were sat and prepared the targets for the upcoming year, which I did when I was working in the previous company. So around this Jan Feb month, we all used to sit together, and I used to take, hey, sales department, what is the sales target for this coming year? Tell me. Marketing department, what is your target? HR department, what is your target? Like that, we get all the data and prepare an estimated financial statement. That is called as budget. We prepare a budget, and that budget, what do? We compare with the actuals. So the financial statement, what you're preparing here is the actual data. So 31st March, which went by 20 days ago, 31st March 2024 ended. So previous year, you would have done a budget, no? So what will you do? The financial year 23-24's data, actual data, will compare with that of budget data and see whether the target what you have set is achieved or not achieved. So like that, so many analysis that we have to do. In 12th, you studied something called as ratio analysis, correct? No? So ratio is what? You are interpreting and analyzing the accounting data. You learn something called as tools of financial statement. Common size statement, comparative size statement, trend analysis. Correct? No? This is also interpreting and analyzing of the accounting or financial data. Then 12 CBC people, you had something called as cash flow statement. That is also a part of analysis. Then you have something called as fund flow analysis. Like there's so many analysis that you have to do. So accounting does not stop with only preparing the financial statement. You have to go one step ahead and interpret and analyze the financial statement. And who will be doing this work? You guys, as a chartered accountant, be doing this work. It's your role. It is your pure, it's your role. And once you analyze the data, what do? You keep the data in your tummy. Oh, I got the profit. Let me keep it in my stomach itself. Let me not tell it to the owner. Let me not tell it to the investor. Let me not tell it to the banker. Owner wants to know, no? Pavam fellow. Full year is worked very hard. He's craving. Tell me what is the profit of my business. Investor invested money. Somewhere he's sitting in the corner of North India. He put the money. No clarity. No clarity what is happening here. He's not in the management, no. Investors are never management. I mean, investors are never in the management. So after 1 year only, they'll get to know what is the position of the business. So he wants to know the hard-earned money that I put, whether they ran a profitable business or just swaha, all my money. They want to know. So what is the final step of the accounting process? Communicating the analysis that you've done to the users of the financial statement. Communicating of the financial information and analysis. The financial information that you have interpreted, analyzed, you need to communicate to the users of financial statement. Who are the users? Internal users and external users. Internal users means owner. External means investors, government, creditors, financial institutions, etc., etc., etc. So accounting process begins with this, ends with this. Sir, after we become CA, do we need to do all this? The answer is partially yes, partially no. Sir, we didn't understand. What did you ask first? After becoming chartered accountant, do we need to sit and do the journal entry? Debit what comes in, credit what goes out. As a CA, should we do that? Depends. If you're starting your own firm, small firm, limited budget, no money to pay salary to staff, so you're one-man army. If a client calls, reception number, you'll pick up. Hello, I'm the receptionist. How can I help you? You're like, no, I don't want to talk to the receptionist. I want to talk to your boss. We want to talk to your boss? Okay. Hello, I'm the boss speaking. One person doing all the activity. Marketing, he does. Obviously, CA, we cannot do marketing, but there's so many roles that individual CA will play on his own. Correct, no? So that time, small files that comes, you have to do accounting, which we did. But if you're a part of a big, large-scale organization, then accounting is not your job. So when I was working in the previous company, I never did any accounting. So accounting is a work that has been done by the junior accountants. So identifying a business financial transaction, measuring in terms of money, recording and classifying up to this stage. Up to this stage of classifying, it is called as bookkeeping. And bookkeeping is done by the junior accountant, because all these are data entry work. These are called as data feeding work. So we as a chartered accountant who has groomed our knowledge to the analysis level, if you ask them to come down and do the entry level, nobody will have the heart, except if your circumstances are extremely that you have to do it, then okay. Maybe there are certain complicated transactions, complicated adjustments. Maybe that you have to do it. Or even that, what do? We don't do it. We tell the entries to the accountant, he will pass the entry. We don't sit and pass any entries as such, as after becoming CA. So the process of identifying till classifying, this is called as bookkeeping. Accounting begins where bookkeeping ends. So accounting part means what? Summarizing till communication. This part, that is from trial balance till the communication. This part is called as accounting. This part is called as accounting, which is done by the senior accountant or the chartered accountant. So bookkeeping is different, accounting is different. And there's something called as accountancy also. So often people get confused that accountancy and accounting both are same. No. Accountancy is the set of rules which will teach you how to do bookkeeping and accounting. Are you able to follow? So bookkeeping is different, accounting is different, accountancy is different. So normally if you see your textbook that you study, majority of the book, the name will be accountancy. The name will be accountancy. This is what is being theoretically explained. This is clear. Can I go forward? There is a definition that is also being given by American Institute of Certified Public Accountants, CPA. CPA. People are scared. Sir, one more definition you're going to explain? One definition it took so long. One more definition, we are going to sleep only. Don't worry. It is copy paste of what we have learned here. So whatever this meaning we have learned, it is almost a copy paste in the different mechanism. So what does the American Institute of CPA says that accounting is an art. Look at my art also first. You don't believe my art? Wait. This is your first unit. The Committee of Terminology set up by American Institute of Certified Public Accountants formulated the following definition of accounting. Such a boring definition. Look at my creativity. You should appreciate. Accounting is an art. Accounting is art of recording, classifying, summarizing. Recording, classifying, summarizing. In significant manner and in terms of money, business transaction and events, which is of the financial character, then interpreting result thereof. This definition is given by CPA, American Institute of CPA. Accounting is art of recording, classifying, summarizing in significant manner and in terms of money, transaction and events, which are part of financial character and interpreting result thereof. So I've taken the keywords. Meaning is same, no? The only difference is, sir, accounting is an art, they're telling. Accounting is an art. What we dumb fellows think? Art means a person who is drawing or a person who is painting. He is an artist. No. Art refers to anybody who is expert in their field is called as artist. We call Talabadi film artist. Why? Because he is expert in his field. A painter as an artist. So artist refers to the person who has mastered his or her profession. Same way, we are called as artists because we are the master of accounting. I am not saying this is the definition given by them. It is an art. Not everybody can sit and do accounting. You tell science fellow to do accounting. Doesn't know. We are pro in that. So what are we doing? Sir, we are recording. Recording where? Through what? Journal. Classifying through what? Ledger. Summarizing through what? Trial balance, P&L, balance sheet. Insignificant manner. Dummy fellow. This is no use. Dummy fellow. In terms of money. In terms of money, where did we learn? Business, financial, transaction, event, finance. In terms of money. Then business transaction. Our meaning only scattered in different way. So in terms of money, business transaction and events, it should be of the financial characters. And interpreting the result thereof. Communicating this fellow forgot. No problem. We have learned in extensive manner. We'll remember. Interpreting results thereof. Any difficulty in this? So no difficulty, sir. Sir, you are a genius, sir. Thank you. You don't appreciate. I'll appreciate myself. So what is the need of accounting? First, to ascertain the financial performance of the business. Financial performance is ascertained by preparing the profit and loss account. Profit and loss account. This is the first primary reason of preparing accounts or the need for doing accounting. So second is to ascertain the financial position. The solvency and the liquidity position. You've studied in ratio topic 12th standard. Liquidity ratio. Short-term solvency ratio. You guys understood the meaning there? Those who did 12th with me, they would understood. If you say I didn't understand, what is the need of accounting? Clear? Easy? Okay. So period of accounting. Normally, you're free to follow any period of accounting. Normally, you have studied this something called as accounting period concept, which says that when a business continues, it continues for a foreseeable future, which means what? Once you start the business, you have no intention to close the business. You want to do it as long as possible. But account says that you cannot keep going on forever. Somewhere you have to stop. Somewhere you have to stop. Put a cutoff. Ascertain the result. So for example, if this is the business is started here. It goes on and on and on. This is Karpa. Doesn't look like one. Anyways, I'll improve on my drawing. Anyways. So business goes on and on and on. So account says that somewhere you have to put a cutoff. So accounting period concept says that ideally in India, the accounting period that we follow is April to March. If you want to follow a different period in accounting, you can do so. You want to do Jan to December, you can do it. But as per income tax, it has to be compulsory April to May. So for convenience purpose, because for accounting, what did I say? Sorry, March. Sorry, April to March. So in normal accounting, we follow April to March, but accounting says that you can follow a different period also. But in income tax, it has to be only April to March. So one accounting for tax separately, one accounting for accounting separately doesn't make sense. So in India, what they do is normally they follow April to March for every type of to satisfy all the acts. So here I'll change it. Thank you. April to March. So the financial year starts from, let's say this is 1/4/24 we are now. It ends when? 31st March 25. So when the starting date is of a different year and when the ending date is of a different year, how do we refer this to as? 24/25. We refer this to as 24/25. So 24 is the year starting and 25 is the year ending. So 1/4/24 to 31st March 25. So period of accounting, are we clear? Now why this is important? Because in the multiple practical questions that we are going to do, they'll say the year ending is happening on 31st March 25. So which financial year they are into? 24/25. Sometimes they'll tell you the financial year ending is ending on 31st December 24 or 31st December 25. Then what is the accounting period? 2025 only. When you're starting with 1/1/24 and ending with 31st December 24, then which financial year we're into? 2024 is a financial year. So 24/25, when do we refer? When the starting date is of different year and when the ending date is of a different year, then we have 2 years put together, 24/25. When the starting date and the ending date is of the same year, then we don't put it 24/25. We call it just 2024. That's it. Make sense? Online people make sense?
Yes, sir.
Yes, sir.
Maybe Sadhana, Sartis, Sadhana,
Sir, yes, sir.
Yes, sir.
Dharni, Dania. Okay.
Yes, sir. Yes, sir.
You want a break? I knew.
Yeah.
So it's 11:47. Let's take a quick break of 3 minutes. We'll come back and continue. Thank you. Yes, people, welcome back to the break. So let's continue. So before break, guys, we discussed first what is accounting. Then we discussed why accounting, and then why accounting rules from the layman point of view. Then technically we understood what is the meaning of accounting. So in that, the two important things that you learned is that identification of a business financial transaction and event. So transaction is basically performance of an act that is involving the exchange of goods or services or funds. And what is event? Event is basically the result of the transaction. So we saw the definition from the normal point of view, normal accounting definition that has been given. We saw that completely. Then we saw the accounting definition that was given by the American Institute of Certified Public Accountants, which was again on similar lines. And now we'll be heading forward to the next topic. We'll be discussing the concept of debit and credit and what are the rules of accounting. So can you see this gentleman on the screen? Very nice question. He's not bothered about this gentleman. He's like the person who's standing besides that man. Who that is? True gentleman. Now, can we focus on the main person? Yeah. He's called as Sir Luca di Pacioli. He's an Italian mathematician, commonly known as father of accounting. He's the person who's conceptualized the concept of double entry system of accounting. Now, the question that arises is that, sir, you call him as an Italian mathematician. We are studying accounts. What is a mathematician got to do with accounting is the primary question. So first of all, guys, accounting is a branch of mathematics. It is emerged out of mathematics only. So underlying base of accounts is maths. In accounting, what do? You record in the financial value, monetary terms. Monetary terms means what? Numbers. Numbers means what? Maths. In accounting, you have plus, minus, addition, subtraction, percentage. So base is coming from where? Maths. So this accounting concept is a branch out of mathematics only. So it is a mathematician who has coined this concept of accounting, and he felt that the best way of laying down an accounting process is by virtue of following the double entry system of accounting. Double entry system of accounting means what? Every transactions will have twofold impact. In that one impact, he felt like calling debit. Another impact he felt like calling credit. Every transaction has got twofold impact. I'm not telling accounts. In a transaction, there can be multiple accounts. But he's not focusing on accounts. He's saying that impact is called twofold impact. One is debit impact, second is credit impact. So one impact, I will call it as debit impact. Second impact, I'll call it as a credit impact. Is what? Is a concept that has been given by Sir Luca di Pacioli. Now, let me give you an example. Let's say you're receiving a salary of rupees 1 lakh. So this is money coming in. This is money coming in for you. But for the opposite person, it is money going out. So for him, money is going out. For you, money is coming in. So two impact. One is the receiver aspect. Second is the giver aspect. So one, you're receiving it. Second, the opposite person is giving it. Now, whatever money comes in, for you also it goes out in multiple ways. So first, it goes out in form of rent. From this 1 lakh, you'll be paying rent. Next is electricity bill for groceries, hotel, etc., etc. So this is money coming in, and this is money going out. So every time the money comes in, you'll keep on adding, 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 adding. Every time the money goes out, all the expenses you will add, add. So this money coming in, you're adding, adding, adding. The money that is going out, if I want to know total money that is going out. So for me to know the total money going out, all the money that is individually going out has to be total. Then if I want to know what is the balance left in hand, then these both I need to subtract. So in accounting, it was very difficult to make people understand when you should add something, when you should minus something. Then Sir Dec'24 felt that like mathematics, it is very difficult in accounting to go with plus and minus. You cannot tell people, okay, plus this in this scenario, minus it in that scenario. This is not possible. It will create a lot of confusion and chaos. So what did he do? He conceptualized a term called as debit and credit. So a lot of time when I ask people what is the meaning of debit and credit, people say, so debit what comes in, credit what goes out. Debit the receiver, credit the giver. That is not the meaning of debit and credit. That is not the meaning of debit and credit. What you said is the rule of debit and credit. It is one of the rule of debit and credit. It is not the meaning of debit and credit. So what is the meaning of debit and credit? Debit and credit is nothing but it is addition and subtraction only. Debit and credit is nothing but addition and subtraction. So if it is addition and subtraction, if it is plus and minus, then why do we have debit and credit? Why can't we use it plus and minus itself? As I said earlier, when you have to add all the money that is coming in, you have to plus. If you have to add all the money that is going out, still you have to plus. When I take a difference, I have to minus. So it became very difficult to make people understand in what circumstances should I add and in what circumstances should I minus. That is why he said that let's coin the concept of debit and credit and let's put a rule into place. Applying this rule, you will automatically know when to add something and when to minus something. You will not put your thought to it. You will not put your mind into it and decide whether should I add or whether should I minus. He said that I'll give you a rule. You blindly apply the rule. The rule will take care of addition and subtraction in itself. So what is debit and credit? Debit and credit is nothing but plus and minus. So does it mean that debit is always plus and credit is minus? Or the debit always means minus and credit always means plus? No. Debit will act sometime as plus, sometime as minus. Credit will act as sometime as minus and sometime as plus. So you don't have to technically remember when you should add something or minus something. You will either apply the golden rule or the modern rule, which in itself take care of addition and subtraction. So what is debit and credit? Debit and credit is nothing but addition and subtraction. Simple layman language I have to explain you. What is debit and credit? It is nothing but addition and subtraction. What is it? Addition or subtraction. Who has given this concept of debit and credit? Sir Dec'24 was called as father of accounting, who's supposedly be the Italian mathematician. Okay, I have a next question to all of you. So first question, what we wanted to understand is, sir, what is the meaning of debit and credit? We understood. What is the meaning of debit credit? Understood. Second, I have a question. Sir, in the word credit, we have an abbreviation called as CR. And for debit, it is DR. Normally, when you take abbreviation, you take 1 or 2 letters or 3 letters from the main word. In credit, we have CR. So it makes sense. But in debit, there is no way DR. So what does this DR stands for?
APS.
No, who said debtor? Debtor. Next, DR stands for debtor. No. How many of you say DR stands for debtor? That I want to know. I want to see those golden faces. That's what school teacher says, no? Cash account debtor. Bank account debtor. Debtor, eh? DR stands for debtor, eh? Donkey fellows. Who has given this concept of double entry system of accounting? Dec'24 is Italian mathematician. So in Italian language, it is not debit. It is called as debier. Credit is called as creditor. So those Italian fellows felt lazy to use the word cash account DBR to bank account DBR to cash. So Asattalla vandu they said DRCR, short form. What did we do in India? We will never accept as it is things. We said that debit is debit, creditor is credit. But as a token of respect to the father of accounting, we absorbed or accepted the abbreviation as it is. So whenever next time you write the journal entry, it is not cash account debtor, it is cash account debit to bank, cash account debit to sales. So DR stands for debit and not debtor. Have you learned something new? Most of you know it already because you've seen my previous classes, but others, okay, fine. So once you identify business, financial transaction people, transaction event, now we talk about transaction. Transaction record in the books of accounts only on the basis of evidence. So all the transaction when you record in the books of accounts, it has to be supported by evidence. If you record the purchase transaction, the purchase transaction has to be supported by a purchase bill or a purchase invoice. If you're doing a sale, it has to be supported by a sale bill or a sale invoice. If you're making a payment, it has to be supported by voucher called as payment voucher. If you're receiving the money, it has to be supported by a document called as receipt voucher. So typically, when you execute a transaction, all the transaction will have a supporting evidence. On the basis of supporting evidence only, you will record the journal entry. Events such as closing stock, depreciation. For that, there is no supporting evidence. There are certain adjustments where there is no evidence. So for that, it's okay. But for transaction, when you record for the very first time in the books of accounts, it has to be supported by the evidence. If you're doing a purchase return, what is evidence? Purchase return. Credit purchase return. Some note is there. What note? That is what I'm asking. Some note. Debit note or credit note? For purchase return. Debit note or credit note? For purchase return is debit note. Debit note is cancellation of the creditor. Guys, credit purchase means creation of creditor. Creditor is credit balance. To cancel the credit, we are supposed to give a debit. For giving this debit, we are giving a debit note. I'll be talking about this in depth again when I do the subsidiary book. Now, yes, since the point has come, I'm just explaining it roughly. Don't worry, those who didn't understand still, don't panic. This topic again I'll detailedly discuss in the bills of in the concept of subsidiary book. So debit note is given for a credit purchase return and credit note is for credit sale return. So for every transaction, it has to be supported by evidence. And what did I say you? Journal or the subsidiary book is the data entry point. So that is called as book of original entry. Book of original entry. Perfect. Now, what is the meaning of debit and credit? Debit and credit is nothing but addition and subtraction. But here, what they have additionally told us, debit refers to the left side of an account. Account, how do we open? So it's a T-shaped format. So left-hand side is called as debit, right-hand side is called as credit. Simple. And the abbreviation of debit is nothing but DR, credit is CR. When you record the item on the debit side of any account, then we say that particular account is debited by so-and-so amount. When you record any amount on the credit side, we say the account is credited by so-and-so amount. So that is what debited and credited means. Because often when you do the practical questions, they tell you that salary is debited to P&L appropriation account or salary is credited to partner's capital account. So you need to understand what is the meaning of debit and credit. Now guys, we are going to discuss the rules of debit and credit. The two methods that has been laid down for you to follow upon while doing the journal entry. One is called as traditional classification, which is otherwise called as golden rule of accounting. Golden rule of accounting. And there's another classification called as modern rule of accounting. So modern rule of accounting, which is also called as American approach, For all CBSE people, you had both the rules very well in your syllabus of 11th standard. However, matriculation people, you didn't have this second method. So I was telling you, right, during my counseling sessions, that in 11th standard and 12th standard, a lot of topics has been missed from your syllabus. So to cover up that, it is very important that you undergo the basic classes that I've given. So today onwards, you'll understand the significance and the importance of the extra class that you're doing with me. Sir, why golden rule? Why modern rule? Very simple. What did we learn? We said no. Whenever you record anything in the journal or the subsidiary book, you have to do 3 steps. First is to identify the accounts involved. Second, that account is of what nature you have to decide. And once you decide the nature, you have to apply either the golden rule or the modern rule. So without this, you cannot pass a journal entry, and without journal, you cannot proceed to the next step of accounting. So let's begin with the golden rule. So what does the rule say? Let's understand. Golden rule says that any account that you identify in a transaction, you can either classify into personal account or real account or nominal account. So typically, if you ask me, there are 2 classifications. One is personal account, one is impersonal account. Under impersonal account, we have something called as real account and nominal account. So under golden rule, there are 2 classifications, personal account and impersonal account. Under impersonal account, you have something called as real account and nominal account. But the rule that is being laid down is laid down for personal account, real account and nominal account. Are you able to understand the structure? Okay. So under golden rule, they say that any account you can classify, you can either classify it as personal account, real account and nominal account. First, I would want to go with nominal account. So what is nominal account? So in a transaction, when you identify an account, and if that account has got the flavor of, income, gain, expenses and losses. In any transaction, once you identify an account, and if that account has got the flavor of income, gain, expense and losses, and for those accounts, the rule that you look up to is nominal account rule, which says debit all expenses and losses, credit all income and gain. I want online people also to participate. Online people, are you all there with me?
Yes, sir.
Yes, sir.
Nominal rule says that when in business, if you come across any expenses and losses, you're supposed to debit. And if you come across any account which has got the flavor of income and gain, then you're supposed to credit it. That is why in trading and P&L account, if you see, credit side you have sale, which is nothing but income, and debit side you have purchases, which is nothing but expenses. So debit all expense and losses, credit all income and gain. Any difficulty? It's not at all. Next comes the real account. So what is real account? What is real account? Sir, in any transaction, if you come across any account which is asset, more specifically tangible, intangible asset. asset basically. All assets. Except bank, debtors, bills receivable, prepaid expenses, accrued income. Whatever you studied in 11th, foundation is advanced version. So something somewhere every time I'll give something new. So if you come across in any transaction account which has got the flavor of asset, but that should be except bank, debtor, bills receivable, prepaid expenses, accrued income, all other assets such as land, building, plant, machinery, furniture, cash, all is coming under asset. So for that, the rule that you'll follow is debit what comes in, credit what goes out. Debit what comes in, credit what goes out. Debit what comes in, credit what goes out. I'll give example, don't panic. So let's take an example. Sold goods of rupees 1000 in cash to Ram. So what is the first step? Identify business financial transaction. So first thing is it related to business? Answer is yes. Do we have any monetary value attached? Yes, 1000 rupees. Second, is this transaction changing your financial statement? Is it having any impact on your financial statement? Yes. So these are the three questions that you have to ask yourself. That is, when you identify this as a business financial transaction event, you have to ask yourself three questions. First, is it related to business? B. Second, is it having any monetary value attached to it? Third, is this impacting the financial statement? Yes. So tell me, guys, is this a transaction or is it an event? It is a transaction because this is involving exchange of goods. It's not an event, it's a transaction. So it is definitely a business financial transaction. Money terms also measured. Now, what are you supposed to do? Record through journal. But for you to record through journal, what is the first step involved? Identify the accounts. So in this transaction, how many accounts is getting impacted, which will affect your financial statement? Which will affect your financial statement? Financial statement means what? Trading P&L and balance sheet. So in trading P&L, what do you record? Income, expense, gain, loss. In balance sheet, what do you record? Asset, liability, capital. So you have to identify those accounts which has got the flavor of income, expense, gain, loss, asset, liability, capital, which is affecting your financial statement, which will change the value of the financial statement. So my first job here is to identify the accounts. Which account? So one is sale account, because I have to record my income. Sale should record my income, increase my income. So sale is my first account. For goods, do we record any account? I mean, do we create any account? No. For cash, do you create any account? Said yes, because here my cash value is undergoing a change. My cash is undergoing a change. My cash is going to increase. So cash is going to change. So account identified. Will it affect RAM account? Sir, RAM account is not affected because this is a cash transaction. Cash transaction means what? When you sell goods, immediately upon receiving the money, that is called as cash transaction. Cash transaction means what? There is an immediate involvement of exchange of the currencies against goods and services. So here I don't need to remember Ram's name. So I'm not opening Ram's account. So two accounts identified. What is my second step? Soma Surya, what is the second step? Identify the nature of accounts involved. Identify the nature of accounts involved. Nature means what? Flavor. Sale has got what flavor? Income. Sale has got a flavor of income. Cash has got a flavor of asset. All assets are real except so and so. So when I did an exception, in exception, did I put cash here? No. So which means it is coming under the category of asset. An asset in the golden rule, it is real account. So what is the golden rule for nominal account? Debit all expense and losses, credit all income and gain. So sale, what should I do? Credit. If this is credit, opposite will be obviously debit. But we'll apply the rule. Cash is real account. Real account golden rule says what? Debit what comes in, credit what goes out. When I sell the goods, I'm receiving money. So what is coming in? Cash is coming in. Debit what? Comes in. Debit what? Comes in. So what will my journal entry? Cash account debit to sale account. So what did I first do? I identified the accounts involved. I identified sale account, cash account. Then I identified what is the nature. As per golden rule, the nature is one nominal, another is real. As per golden rule. As per golden rule, what is the nature? Income is fine, but this is not right. This should be actually nominal. So as per golden rule, the nature is nominal for sales and real for cash. Then what did you do? You applied the golden rule. Golden rule said what? For nominal account, you have to credit the income, and for real account, you have to debit what comes in. Money is coming in, so debit. Easy? Diya, easy or not easy? Very easy. Okay. So next, let's talk about personal account. Under personal account, there are 3 more bifurcations. Listen to me very, very carefully. I'll ask questions here. Under personal account, there are bifurcation. First is natural personal account. Natural personal account. Next is artificial personal account. Third is representative. Spelling. Representative personal account. Kya sir kya? Before you said I completed the spelling. Now, personal account is bifurcated into 3 categories. Natural personal account, artificial personal account, representative personal account. So what is natural person account? What does natural person means? Created by God. Human being. So all human beings are natural personal account. We are called as natural persons. Okay, so we fall under this category. Then there's something called as artificial person. Artificial person means what? You call it as a person, but it's not the creation of God. It is the creation of law. It is the creation of law. So example, companies. So if you studied the Companies Act definition, so they say that company is an artificial person created by law. So your sole proprietorship concern, partnership concern, all the corporate, whether it is OPC, private company, public company, all are called as artificial person. So we call them person. Who calls it? Law says that you are a person. But is it a natural person? No. Correct? No? They are artificial person created by law. So we call it as business entities. Business entities. And the financial institutions. Business entities and the financial institutions. Example of natural personal account is Ram, Sham, Lakshman, Bharat, Sita. Example of artificial person. Reliance, I said artificial person, Reliance Limited. Business entities, Reliance Limited. Tata Motors Limited. Kalprix Academy. I was wondering, I was waiting, somebody will brand my, very good. Fortune's Fund Learning Academy. Any sole proprietorship form of business, any partnership form of doing business, companies, corporates, all are artificial person. Financial institutions means bank, NBFCs, all this comes under artificial person. But now I want to understand from all of you, what does representative personal account means? Don't tell me the example. I want meaning. Tell me the meaning of representative personal account. I only Huh?
To whom amount is to be paid?
To whom amount has to be paid?
Should be paid to a person.
Ah.
But actually it's not to be a person.
Okay. She's got close point. Others. What is representative personal account? Representative personal account, which means we are going to make the payment or receive the payment from a personal account, but that person is neither natural nor artificial. Rather, he is a representative of the natural or artificial personal account. So we are going to receive money or pay money to some person, but that person is not a direct natural person or a direct artificial person. He's been a representative. Then that is called as representative personal accounts. Be careful, ma. Representative personal account. So what does all come here? One example I'll give you. Outstanding expenses, prepaid expenses, accrued income, income received in advance, bills receivable, bills payable. Example of outstanding expenses, let me give you. Classic outstanding example, outstanding expenses, classic example is salary outstanding. Outstanding salary means what? From the staff, I've taken the service. So expense is due, but I've not paid it. I'll pay it next month. So outstanding salary. Is this expenditure? Outstanding expenses, is it expenditure? No. Salary is expenditure, but the salary which is due but not paid, which I have to pay in future, is liability. And outstanding expense is liability. So why do you call this as representative? Why can't we call it as natural person? Because I have to pay salary to human being. No, I have to pay salary to human being. The 10 employees working under me, 10 of them are human being. Then why can't we classify it as natural personal account? If I ask you, then what will you answer?
You're already thinking that we have to pay this in future. So
Correct.
Keeping the money aside.
My question is, why are we not calling them as natural personal account? Why is it representative? Why is outstanding salary not a natural personal account? Because I'm going to pay salary to my 10 staff in future.
Because they are like assets of the company.
Emma, outstanding salary, liability, employee asset of the company. But this liability, no. This liability, no.
One salary paid.
Again, close, very close, but not to the point. Yes. Now remember, I'm an organization that has to pay salary to 100 people. 100 people salary I'm yet to pay, because normally I have a concept of paying the salary 5th of next month. So March month, whatever salaries like people have worked for me in the month of March, the company has got the policy of making the payment on 5th of April, let's suppose. But March, I have to record the entry, no? Based on the matching principle, I'm supposed to record the entry in March. Why? Because matching principle says that if you've got the service from the employee in the month of March, then the expense also should be recorded in the month of March. So we record the entry salary to outstanding salary. So salary is what? Nominal account. Debit all expense and losses. So salary is debited. Outstanding expenses, what classification? Outstanding salary is not nominal, neither real. So it is personal. In personal, which category? If you put personal category, the problem is then for 100 different employees, you should have 100 different accounts. Then are you trying to tell me that the salary entry, salary to salary outstanding, I will pass 100 times for each and every employee? I don't have any other work at the year end. Salary to Ram payable, salary to Sham payable. For that one accountant, I need separately paying salary. So we cannot do that. So whenever you see in any company, when you go for auditing, the salary outstanding entry will be one single short entry. If let's suppose 10 lakh is the total outstanding salary for the month of March, the one single entry will be salary to outstanding salary. So outstanding salary was what? The salary which is yet to pay to those 100 human beings. But since I'm not creating independent account, since this outstanding salary is representing the 100 people, I call this outstanding salary as representative personal account. So this outstanding salary is going to be paid in future to a human being. But since I'm not creating each and every human account, each and every human being's account, since I'm recording on the whole, this on the whole term outstanding salary is called as representative personal account, because this outstanding salary is representing the natural personal account.
Outstanding debt to one landlord. Why is it not actually?
Coming. Everything will be satisfied. This is the typical mindset behind creating the. So when I say outstanding salary, when I'm representing a group, it doesn't mean that it has to be 100 people. Even if one person, I want to make the payment, and if I don't want to create his ledger name, I don't want a ledger name to be created in that person's name, then in that case, I'll be recording as representative personal account. For example, what Nishi asked. So you're paying rent to the landlord. So rent is outstanding. So what is the entry? Rent to outstanding rent. Now here you have only one landlord, no? Here you have only one landlord. You can open the ledger name. Then why outstanding rent? Why? Because I don't want to create the ledger name in the name of personal account. Let's suppose the landlord's name is Ram. I don't want Ram's name to be reflected anywhere in the accounts. Then I classify it as outstanding rent account. So whenever you don't want any name to be classified anywhere, then you use a representative word, that is representative accounts name.
But it's by choice, not by need.
It is not compulsion, it is by choice. So for example, if you want to create the rent payable ledger in the name of landlord, let's say Ram rent payable ledger, you can do it. Then that becomes your natural personal account. But where you're not using the individual person's name, rather representing such name by such accounts, then we call this as representative in nature. So here rent payable to the landlord, the name we used is outstanding rent account. So that outstanding rent account is representing Ram. That's why it is called as representative account. Let's talk about income received in advance. So all of you have paid the coaching fees for the foundation in advance. So what is the journal entry? What I'll record? Cash or bank account debit to income received in advance. This concept many of you might not know. If you know, well and good. Those who studied with me, definitely you know this. That you cannot record an income unless and until it is earned. You cannot record the income unless and until it is earned. So when do you say income is earned? In case of service industry, I say my income is earned when I have completed the service for you. When I completed the CA Foundation accounts coaching, when I completed my coaching, then that is called a service completed. And upon completion of service only, I have earned the money you have given me. So now the advance money the money that you have paid to me is not my income. I will not record as income. I'll treat this as advance money. I will record this as income when next time when I complete the service. So this is my liability. This is my liability. Now here I got advance from all of you. So will I sit and create a ledger for all of you, for each and every individual name? Like that, then how many ledger names I have to open? So here accounts has given me a flexibility telling that in case if the income is received in advance from a group of people, instead of opening the individual group ledger, you can have a combined ledger in name of income received in advance. So this is representing all of you individually. All of you are human being. So it is representing you guys as human being. So this is called as representative personal account. Am I clear? Similarly, your prepaid expenses, accrued income, bills receivable, bills payable. Bills receivable, bills payable is also representative of the debtor and creditor. So bills receivable is coming from debtor. So it is representing a debtor. Bills payable is representing the creditor. So these are called as representative personal accounts. Am I clear with this one? Now, what is the meaning of bills receivable, bills payable? All that I'll discuss in the bills of exchange topic. Now, my only discussion here is why do we call this as representative? Representative meaning is what? Meaning means it is representing either a natural personal account or artificial personal account, which means when I record something as a natural personal account, I open the name in, I open the account in the name of Ram. When I say something is artificial personal account, the account is opened in the name of Reliance Limited. But when I don't want to open Ram's account and Reliance Limited, I want to open a common group name, then we call it as representative personal account, which will be either in form of outstanding expenses, prepaid expenses, accrued income, income received in advance, bills receivable or bills payable. Is the concept clear? Online people, is the concept clear? How many of you felt that
Yes, sir.
something new that you've learned with regarding this today? Raise your hands honestly. How many of you felt that this explanation of representative personal account is something new that I've learned today? Now much better. I've put efforts for, explaining so much. So thank you. Pooja, yes, I got your answer. Now, listen to me. All liabilities including bank, debtor, bills receivable, prepaid expenses, accrued income. If you see, these are all asset. Bank is asset, debtor is asset, bills receivable is asset, prepaid expense is asset, accrued income is also asset. So whatever we excluded here, from this, whatever we excluded, where are we including in the personal account? So why do we call this as personal account? If I have to talk about liability, so what is liability? So anything that I have to pay in future is liability. Anything that I have to pay in future is liability. So you take capital from the owner. So capital is your internal liability. What is liability? Anything that I have to pay in future is liability. If that money you are supposed to pay to the owner, then we call that as internal liability. If that liability you have to pay to the external people, we call it as external liability. So capital is a representative personal account. If you open just capital ledger name, then it's representative. If you open Ram's capital account, that is natural personal account. Please understand, if you open a common ledger called as capital account, then the capital is representative in nature. Drawings account, representative in nature. But if you open the ledger in the name of the natural person or artificial person, then that is called as natural personal account or artificial personal account. Let's suppose you're opening a ledger named Ram's capital account. So what is the classification? Natural personal account. So Ram is giving capital. So what is the rule? Debit the receiver, credit the giver. So Ram, what are we doing? Crediting because he's the giver. Debit the receiver, credit the giver. So liabilities will come here in the personal account category. Bank, what classification? Bank is always in business entity. Bank is never a natural person. It's always an artificial person. So artificial person, hence it is coming under the artificial person account category. Debtor can either be human being or it can be artificial or it can be representative. So it is not coming under real, it is coming under personal account basically. Same way bills receivable, prepaid expenses, accrued income. So I gave you the logic why bills receivable, prepaid expenses, accrued income is a personal account. It is moreover representative personal account because these three are representing a group of people. Am I clear? So all liabilities, including these 6 items, are personal account. And for the personal account, the rule that is applicable is debit the receiver, credit the giver. Debit the receiver, credit the giver. Any problem here? Any problem here? So all of you clear with this point? So golden rule says that each and every account you can classify under 3 categories. Either that is personal account or real account or nominal account. If you identify some account as personal account, what is the golden rule? Loudly, everybody in chorus. If you identify something as a personal account, what is the golden rule? Very good. If you identify something as a real account, then if you identify something as a nominal account, aha, what a chorus. Thank you so much. Now, before I head forward, I need to further make you understand what is the terminology of liability? Liability when is, sir, anything that I have to pay in future is liability. See, we human beings are like Gajini. All of you know who is Gajini? That Mota fellow. He does not remember things, no? What does he do? He will write it down in the, or like he'll write it on his body. I have to make a payment to 10 different people. Shall I put on my body or pay Ram 10,000, pay Sham 15,000? Every time I want to make the payment, open my shirt, oh Ram, oh sorry, I have to make the payment. Okay. Can we do that? No. So we human being like Gajini, we forget. So we have to note it down. So we have to note it down, not possible in body. So we are noting it down on the piece of paper. And the place where we are noting it down is called as balance sheet. So balance sheet is a place on the liability side where we remember anything that you have to pay in future to anyone. So it is liability. So anything that you have to pay to anyone in future is liability. Anything that the business has to pay in future is called liabilities. So what is the meaning of asset? Anything that the business owns, has control over, and derives long-term benefit is called as asset. Listen to me very carefully. Anything that the business owns and has control over, and the word is not and, it is and bar or. Anything that the business owns and has control or has control over and derives long-term benefit. Long-term benefit means benefit from more than 1 year. Benefits for more than 1 year. We call that as asset. For example, if I talk about land. Land, I call it as asset. Why? 3 conditions to satisfy. 1, I own it. Second, I have a control over it. When I'm talking about land, there are 2 types of land. One is called as freehold land. Have you come across this term, freehold land? Second is leasehold land. I'm talking about freehold land. Freehold land means what? The property which is registered in your name is called as a freehold land. So I own it. On that land, can anybody, any third party can come and do whatever they feel like doing? Not possible. I only can do whatever I want to do on that piece of land because I have control over it. And this land is going to help me in future for more than 1 financial year. If all these 3 conditions are satisfying, you can call something as asset. Then something called as leasehold land. What is leasehold land? What is leasehold land? So you pay straight 1 crore rupees to the landlord. And that landlord is giving you the right to use this land for 20 years. How much money you're paying? 1 crore. You're paying 1 crore to the landlord, which means you're not the owner. You're not the owner. You're paying 1 crore rupees and getting the right to use that land for 20 years. So here you are not the owner, but you are having control. So when I use the word and, means what? In case of freehold land, I should own it and plus I should have a control over it. Plus and I should have a long-term benefit. But when I use the word or here, or is for certain other type of assets where I cannot own it, but I'll have a control over it. Example is leasehold land. Leasehold land, I cannot own it. The moment I put own and control, then it becomes a cumulative condition to be satisfied. But the word I put is or. Means what? It is not necessary that an asset needs to be 100% owned all the time. Sometimes you don't own it, somebody else own it. But for a particular period, you have a control. And from that, if you're deriving a long-term economic benefit, means what? Economic benefit means what? You're able to derive some business out of it. If it is helping you in your business, then we call that as asset. So for you to call something as your asset, 3 conditions needs to be satisfied. In that first condition is optional. That is, owning is optional. But second condition, control over and long-term benefit is mandatory. That is why I use the word and. So control and long-term economic benefit, or owns, controls and long-term economic benefit. Are you clear with this point? So anything that I own or control, which helps me derive economic long-term benefit, is called as asset. Point number 1. Or anything that the business receives in future is called as asset. For example, the money which is there in the bank, you can either say that I own it, or you can say that whenever I demand, the banker is supposed to pay me the money back. See, when I have money in the bank account, it is my money with the bank. Who is having the possession of the money? Banker. So whenever I ask, he has to give me back. So bank money will come back to me in future. So anything that I'll get in future is asset. From debtor, I have to get money in future. So debtor is my asset. So why is debtor asset? Because I have right to receive that money in future from the debtor. Cash, I own it because it is under my custody. So I say cash, I own it. I'll be able to follow. So asset, 2 meaning, 2 classification. Anything that you own or control with economic long-term benefit, or anything that you expect to receive in future is called as asset. So are you clear with the definition of asset? How many of you felt that this is something new which you have studied for the very first time? No? Only 2-3 people raised. Others you knew? Economic long-term benefit, control, owns, control. I never said this in any of my previous video. Raise your hand properly, honestly. What is there in admitting? Good. So are we clear with the meaning of asset and liability? Meaning of income or revenue? Because nominal account says what? Debit all expense and losses, credit all income and gain. So you should know what is the meaning of income, gain, revenue. No? So income is again of 2 types, direct income and indirect income. Income generated from the principal business activity or core business activity is called as direct income. That is the main purpose for which you started the business. From that purpose, we get the income that is called as direct income. So CA.Prathik Academy, what is the prima facie motive? To provide education related services. So the coaching fee is my principal activity. So from that principal activity, if I get income, then I call it as my direct income. Now let's suppose whatever money is earned from that business, I have a savings, I have a reserve, and that reserve I've invested in the fixed deposit, and on that I'm getting interest. That interest income is my indirect income. So income generated from the non-core business activity or through sources other than principal business activity is called as indirect income. Did I start CA.Prathik Academy that one fine day I'll have some reserves and savings, I'll deposit this money in fixed deposit, I'll enjoy the interest? With that motive, did I form the business? No. The main objective, the primary objective is providing the education related services. It so happened that along with this business, I had some savings, and that savings I deployed in some other sources, and that other source is giving me an additional income. So is it my core business activity? Is it the core purpose for which I started academy? No. So it is called as non-core business activity. That is indirect income. So direct income you record in the trading account, indirect income in the P&L account. This is clear? Sir, expenses. Expenses means cost incurred to earn the income. Everything that you pay from your pocket is not expense. If you spend money from your pocket, you think it is expense. No. Account says that expense means the cost incurred to earn the income, to earn my current year's income, to earn the income, whatever expenditure I've incurred. Look at the language, incurred. They never said that the money spent, cash spent, expense spent. They didn't use the word cash spent. Spent means money going out. Then the meaning becomes wrong. The word that they've used is cost incurred. Now, what is the meaning of incurring? I'll explain in the upcoming classes. So expense means the cost incurred to earn the income. To earn the income, whatever cost I have incurred, whatever the cost I have incurred to earn the income, whatever cost I have incurred, that cost becomes my expenditure. This meaning of expenses is coming out of two concepts. One is accrual basis of accounting. Second is matching principle. This meaning is derived keeping into consideration two important elements. One is accrual basis of accounting and second is matching principle. You'll understand it eventually. Don't worry. Next. Sir, expenses again are of two types. Direct expenses, indirect expenses. What are direct expenses? Those expenses which are necessary to produce. Produce means what? Manufacture any particular product. Now I call that as direct expenses. For example, to produce or manufacture a product, what do I first need? Raw material. So raw material is my direct expenses. Then I need direct labor. Without labor, can I produce it? No. Without factory, can I produce it? No. So factory rent, direct expenses. So anything which is directly attributable for the production of a particular product, it is called as direct expenses. Or purchase of a product, which means you're a trader. Means your job is buying and selling, buying and selling, buying and selling. So without buying the goods, can I sell it? So for selling, what is the primary requirement? Buying it. So purchase is my direct expenses. That is why all of them comes in the trading account. I'm just trying to give a recap. Rest in the final accounts we'll be discussing in depth. So anything which comes in the trading account is basically your direct expenses. Means these are those expenses without which I cannot even start my business. Without raw material, I cannot produce it, manufacture it. Without labor, I cannot manufacture it. Without factory rent, I cannot manufacture it. Without factory electricity, how can I manufacture? Without purchasing the goods, how can I sell it? So all these are my direct expenses. So what is indirect expenses? So these are those expenses which are necessary to support the business. Direct expenses means if I do not purchase, I cannot sell. If I do not buy the raw material, I cannot manufacture. If I cannot manufacture, I cannot sell. But all the indirect expenses, office rent, office electricity, reception, staff salary, all these are expenditure which is supporting my business. Let's suppose I manufactured a product here. Is it necessary that if I only open a shop, I'll be able to sell? No, at home I can sit, do tie up with Amazon, I can sell it online. I can sell it online. So having a shop is not compulsory. It is our comfort. It is a luxury that we want to open a shop and do the business. So all the items that comes in the P&L account primarily are those expenses which are supportive in nature. These are enhancing my business support. That is called as indirect expenses. So are we clear with the term asset, liability, income, expense? Capital, all of you know what about capital is. Capital means the initial amount contributed by the owner for funding the business is called as capital, which is a liability again. Because when the business is closed, we have to repay the money back to the owner. So it is a liability. But capital is a internal liability. All other liabilities are external liability. Any money that I have to repay to the owner, internal liability. Any money that I have to pay to the outsider is called as external liability. Any problem here? Any problem here? No problem. Okay. What is double entry system of accounting? Double entry system of accounting says that every transaction will have twofold impact. In that, one impact will be debit, another impact will be credit. They are not telling that each and every transaction will have two accounts. In some cases, you have three accounts also. Two in debit, one in credit. Or one in debit, two in credit. So they are not focusing on accounting. They're taking two aspects. And this aspect says that the total of the debit should always be total of the total of debit should always be equal to total of credit. The total of debit should always be equal to total of credit. This is double entry system of accounting. This concept is coined by whom? Sir Luca di Pasquale, who is an Italian mathematician. According to him, every transaction got twofold aspect. One is debit aspect, second is credit aspect. And these both are recorded together in the books of account. If you record both the aspect, then which means you're following double entry system of accounting. But by chance, if you record any one aspect alone, which means then you're following single entry system of accounting. So what is single entry? We have a separate chapter for that. So that time I'll tell you what is single entry. Therefore, every transaction, at least 2 accounts are affected. At least 2 accounts. They're not only 2 accounts are affected. At least 2 accounts are affected. In that, one aspect is debit aspect, another is credit. To analyze the dual aspect of each transaction, there are 2 approaches followed. One is accounting equation approach, is called as also American approach or modern rule. Modern rule. Traditional approach is called as golden rule. So 2 approaches are there. So first we did traditional approach, which says that in every transaction, first you need to identify the accounts. And the accounts you have to classify. Nature. So what is the nature under the golden rule? Either it can be personal account, real account, or nominal account. So under personal account, we have natural, artificial, representative. So under impersonal, we have real and nominal. What is the rule for the personal account? What is the rule for nominal account? What is it for rule real account? Very good. The rule has been given here. Let's do this example. Started business with capital. So identify a business financial transaction. First of all, is this happening in the course of business? Yes. Yes. Is this involving any financial aspect? Yes. Yes. Is this transaction or event? Transaction. This is a transaction. So I have identified this as a business financial transaction. Also measured in terms of money, and the common denomination is INR 50 lakh rupees. Now, second, recording through journal. For you to record the journal, there are 3 again steps. First is identify the accounts involved. So what is accounts involved here? So started business with capital of rupees 50 lakh. So this not possible. Capital is one account, and a double entry system of accounts said that every transaction should have at least minimum 2 accounts. So one is capital account, and there is missing. How is it missing? So rupees is there? No, rupees is cash. So one more is cash account. So one is capital account, second is cash account. So identified the accounts involved. Second is nature of account as per golden rule. As per golden rule, capital is your natural personal account. If you're opening the name, let's say Ram, this is Ram's capital account. There is natural personal account. So personal account. And cash is your real account. So what does the personal account says? Debit the receiver, credit the giver. So capital, Ram, is a receiver of money or giver of money? Giver. He is giving the capital, he's giving the money. So debit the receiver, credit the giver. So credit the giver. Cash, real account. Debit what comes in, credit what goes out. So when the owner is giving the money, business is receiving it. So debit what comes in. So whenever you talk about the personal account, it should be from the point of view of the individual person. So individual person's point of view, whether he's giving or receiving. So from his point of view, giving a receiving aspect. Whereas real account from the business point of view, coming inside the business, going outside the business. Right? So now, started business with capital 50 lakh, involves 2 accounts. One is cash or bank account, second is capital. If you're taking bank account into consideration, bank is not a real account. Bank is your personal account. Which personal account? Artificial personal account. So debit the receiver. So banker is receiving the money. Ram is giving the money to banker. So banker is receiving the money. So debit the receiver. So bank is debited. And who's the giver? Owner is the giver. Credit the giver. So if you take bank into consideration, then it is artificial personal account. Even if you put real account, you'll get the answer. But prima facie, bank is an artificial person. So which is a more appropriate classification for bank, real or personal? Personal. But if you're taking cash into consideration, then it will be real. So in question, when they don't specify cash or bank, you'll always choose bank. In the foundation level, always bank. In foundation, when nothing is mentioned, always bank. Now, so which rule did you apply here? Golden rule you applied. Next, wages and salaries paid. Is it a business financial transaction? Yes, sir. Because it's wages and salaries for my staff who work in my business. So it's a business transaction. Involves finance money. And it is a transaction by transaction because staff is giving service and for which I'm paying it. So it's a transaction happening between the business and the staff. So it's a business financial transaction. Measured also in terms of money. Now, recording through journal. First is identify the accounts. Which accounts are affected? Wages and salaries is one account. That's all. Sir, paid means bank. Paid means bank. So here in a transaction, how many accounts are there? One account, two or three account? Total 3 account. Okay, wages and salaries together. So wages separately given, salary separate means total 3 account. Wages 1 account, salary 1 account, bank 1 account. But here wages and salaries are together. So it is one common account. So one account for wages and salaries, another for bank. So what is the classification? So wages and salary, what flavor do you get? Flavor. Expense. So what classification? Nature? Nominal. And what is the rule? Debit all expense and losses. Bank is artificial personal account. Debit the receiver, credit the giver. So bank is receiver or giver? Bank is on your order giving the money. So it's a giver, not receiver. So credit the giver. So debit wages and salaries and bank will be credited. So wages, salaries account debit to bank. Next is rent received. Rent received. 2 accounts affected. One is rent account. Second is cash account. Bank account. It's not mentioned, so it is bank account. So rent, what classification? So rent, I got the flavor of income. So income will come under which classification? Nominal. What is the rule? Debit all expense and losses, credit all income and gain. So credit all income and gain. Bank is artificial personal account. Debit the receiver. So guys, we are receiving the money. So when somebody is paying the money, who is receiving it? On our behalf, who is receiving it? Bank. So it is your artificial personal account. So debit the receiver. Debit the receiver. So bank account debit to rent. Any problem? Easy. Purchase made on credit. Purchase made on credit. Which accounts affected? Purchase account. Purchase means what? Anything that I buy with the intention to sell is purchase. Now let me give an example. I'm into business of buying and selling furniture. So I purchased furniture. Purchased furniture. Is it purchase or is it asset? Purchase. Why? Because I purchased the furniture because I have intention to resell it. So this is not asset. This is my goods. Let's suppose Kalpvriksh Academy is purchasing furniture. So for Kalpvriksh Academy, this furniture is goods or asset? Asset. Why? Because I'm going to use it on the long-term basis for my economic benefit. So what is the meaning of asset? So anything that you own or control and from that you derive a long-term economic benefit, then that is asset. So this furniture, I purchased it. So it is in my name. I own it. I have a complete control on my furniture. And using this furniture, I'm going to increase my business. So it is my asset. So purchase furniture goods. This is for resell. Resell. So if you're buying any goods which is for intention to resell, that is purchase. If you buy any goods which the intention is to use it, then it is your asset. So here purchase made on credit. Nothing is mentioned means the intention is to resell. Purchase made on credit. So which accounts affected? Purchase and creditor. So purchase is my expense and rule is nominal rule. Debit the receive. Sorry, debit all expense and losses. and creditor is a name is not mentioned. So otherwise, if the creditor is Ram, this natural personal account. If creditor is Reliance Limited, artificial personal account. If creditor is bills payable, it represents creditor. So personal account credit the giver, because I told you when the giver and creditor is from the individual person's point of view. That person is giving to you something or receiving something. So here the creditor is giving the goods to us. From his point of view is the giver. So credit the giver. So this point of view is very important. Giver and receiver from his point of view, opposite person's point of view. Whereas you will see the real and nominal from the business point of view. When I say debit what comes in, credit what goes out, business, in business money is coming in or going out. So real account, nominal account from business point of view, personal account from the opposite person's point of view. Goods sold and the payment received in check. Goods sold and payment received in check. Is it a business financial transaction? So yes, this is happening in course of business involving money, and it is a transaction of goods exchange for money. Okay, first thing done in the first step of accounting. Second step is what? For journalizing, what is my first step? Identify accounts involved. What is the accounts involved? Goods, you never open any ledger. You don't open any account. So goods will not come. Sold, sale account. Payment received in check. Check means bank account. So sales is got the flavor of income. So income, what is the rule? So income, what is the classification? Nominal. Golden rule. Debit all expense and losses, credit all income and gain. So sales is nominal, it is a gain. So credit all income and gain. Bank is your artificial personal account. So in bank, money is coming in or going out? Goods sold, payment received in check. So we received it. So our banker is going to receive the money. So debit the receiver. It's always from the opposite person's point of view. So bank's point of view, bank is going to receive the money. So debit the receiver. Bank account debit to sales. Any problem? Are you all clear with the term books of accounts? When this journal, ledger, trial balance, financial statement, we put all of them together. That is called as books of accounts. Olden days, we are following the manual system. So we call it as books of accounts. Now, even though you are having computerized accounting, still we call it as books of accounts only. The same name has been continued. All of you understand what is cash transaction? When a transaction happens, and on the spot, if the money is also exchanged, on the spot money also is exchanged, it's called as cash transaction. Credit transaction. Transaction is happening, exchange of goods or service happening, but the payment is not happening immediately. The payment will happen at the later stage. That is called as credit transaction. So these are the basic few things which I wanted to discuss today. Are we clear with this point? Online people, are you clear with this point?
Yes, sir.
Yes, sir. Yes, sir.
Now what are we left with? Modern classification. Golden rule prima facie faces some inherent limitations, which means there are certain places where the golden rule cannot be applied, and to overcome such challenges in those places, experts have drafted the concept of modern classification of accounts. So in the next class, I'll be able to tell you which are all the circumstances or the type of entries where the golden rule is a total utter failure, and how the modern rule is going to come into our rescue is what we are going to see. In the entire journey of your CA, guys, specifically in foundation, the golden rule is limited only to the discussion of this chapter only. That is, if you get any question directly in the exam which says you to classify under golden rule, then I use that rule. Otherwise, for all the chapters that we're going to deal with in the foundation, inter and final, we're only and only going to apply the modern rule. It is a modern rule that we are going to apply everywhere. All of you have seen this in the 12th CBSE also. Everywhere we only applied constantly modern rule. We never applied anywhere golden rule. So far comfortable? Today my pace was a little bit slow, just because it is the first class. To set that momentum and pace, the class was slow. But as we proceed, guys, we have to little bit pace up. So my humble request is, whenever you come for the class, if you could do a recap of those concepts from your CBSE book that I suggested, from that you do a recap and then come, you'll be able to get with my pace. You'll be able to get along with my pace, right? So definitely from next class onwards, the pace is slightly going to increase, but wherever you feel that, there is a kind of discomfort, please feel absolutely free to raise your hand, stop me then and there and tell me, sir, please go slow, or sir, I didn't understand this particular point, so please re-explain me. Guys, I'm not done. Settle down. Wait. A lot of people have, a point in their mind that, whenever they come and ask me also doubts, sir, I have a small silly doubt, can I ask? In my dictionary, there's nothing called a small doubt. In my dictionary, there's nothing called as silly doubt. I always tell people that if I take a small pin and prick you, you'll bleed. If I take a big sword and prick you, still you will bleed and pain. So how does it matter whether the thing is affected by the small needle or big knife? Doesn't matter. So same way, whether it's a small doubt or a big doubt, it has got some discomfort in your mind and heart. So any discomfort you get at any stage of time, please absolutely feel free to come and ask me. First point. Second point, see, when we have classes, normally it runs in the duration of 2.5 to 3 hours. I don't expect that every person should have 100% concentration in the class. It's not possible. Even if I'm sitting on the opposite side, it is not possible that 100% throughout 3 hours I'll be listening to the teacher, because our human being, human nature or mind is like that. We just little bit get carried away by our external thoughts or something that is happening in personal life. No, we just get normally carried away. So I have that belief, and by that virtue, I have the habit of repeating things in the class. So a person who misses out the point there might capture it when I repeat it, but that is only possible wherever I repeat those points, you are safeguarded. But where I don't repeat. So in that scenario also, in case if you have doubts and if you feel that, sir, I was not able to concentrate on that particular moment because of so and so XYZ reason, but this very important point I didn't understand and I'm not able to connect to your upcoming topic. So can you please repeat one more time? If you tell, I'll do it. So I understand this is inherent leakage in the human system that you might miss out on the concentration, which I don't advise. I mean, try as much as possible to concentrate in class, but by chance you miss it out, don't feel hesitant that, oh shit, I didn't listen to sir in class. If I go and ask him, what will he say or what will he feel? So that kind of comment or negative comment will not come from my side. But if too much of that is happening, then I'll probably warn you, because too much of lack of concentration also is bad. Here and there, one or times you're missing it out, it's fine. But again, like since sir said, whenever you have doubts, you call me. That doesn't mean that you sleep in the class and now call me midnight. Say 2 o'clock, my brain is superbly working now. Tell me what did you explain in the class one more time. Not possible. But wherever you have doubts, I'm there to help you out. Right? So in the upcoming classes, I'll suggest you certain revision techniques which you have to follow in accounting and for other subjects also. And apply that. If it gives you a good result, if you're able to, feel good about that revision, well and good. But if you don't feel comfortable with those revision techniques, if that is not helping you, please feel absolutely free to come and discuss with me, telling that, sir, this revision, they are constantly laughing. Diya and Nishi, not done. So whenever you feel that such techniques are not working out, come and sit with me. I'll understand what is wrong with the revision technique that you're following, and accordingly, I'll give a customized plan. Because each and every individual has got their different grasping ability, application of mind, retention capacity, it differs. So the general technique that I give you is like 80-90% will help all people across, but there could be exceptional 10-20% people who might want a different plan because they have different mechanism to study. So in that case also, come and discuss with me, sir, this is the thing, how do I deal with and cope up with this subject? Please guide me. In that way also I'll be guiding. Like this comfort is good enough. Comfortable. Though we said that in the beginning that we want to score 100 or 90 plus or 95, at any point of time, do not take that as a stress or a burden. Let me be very clear. See, when we say that the score we wanted to be maximum, that is only a driving factor, because there should be a goal or a purpose which should drive us. So that driving mechanism is that. But don't focus on that 100 mark or 95 mark. Rather, what I say is focus on the process that is required to get that 90 for 100. This I'm not saying who says it. Dhoni. So I copy pasted the dialogue from there. But what's wrong in that? I'm just reiterating the point. So focus on the process, guys. Concentration in class is very important. Revision techniques following is very important. Test writing is very important. Analyzing where you're going wrong is very important. And finally, seeking guidance wherever required. The 4 pillars which I discussed in the very first session. Please take care of those 4 pillars adequately right from the very beginning. Success is confirmed. Clear with this point? So on that positive note, let me put an end to today's session, guys. That's all from today. From my side, I'll see you in the next class, which is probably next week. Until then, bye-bye. See you. Take care. Thank you, people.
Yes, sir.
Thank you, people. Online people.
Thank you.
Thank you. Thank you.
Thank you, sir.